Welcome back to the channel that simplifies the stock market. Now, you clicked on this video because you want to be a successful stock market investor, right? Like you want to make a lot of money in the stock market. Yeah, if that's the case, then go ahead and make peace with the fact that you'll have to get very good at reading and analyzing financial statements. And that's what I'll be taking the time out to show in these next few videos. I'll go over each of the financial statements, but first we'll start off with the income statement. So in this video, we'll get into what exactly an income statement is, and then we'll explore why you should understand income statements if you hope to be a successful stock market investor. Like, why should you bother? After that, we'll look at the income statements of 3 different companies. And then to end the video off, I'll show you how you can find a company's income statement. Now, once you watch this whole video all the way through, you will have a better understanding of the income statement. And listen, the way you'll really get great at reading income statements and becoming a more confident investor is by actually going out and applying these things. What I'm about to show you is actually applicable to real life. Like, you'll actually use this information. And very often when you're looking to invest in great companies in the stock market and make a lot of money in the stock market. So again, when you're done watching this video, go out and actually look at the income statements of different companies. Now let's get into it. Now, diving straight into it, the first thing we need to understand is what exactly is an income statement? And it's pretty simple. The income statement shows a company's revenue, expenses, and profit over a given time period. And they typically include 4 main sections: revenue, expenses, profit, and then other useful information such as the total number of shares outstanding in the company and the earnings per share. Now, public companies that have their stock traded in the stock market like Apple or Tesla are required to release their financial statements to the public so that potential investors like you and me can actually look at the financial posture of a company before we actually choose to invest in it by buying its stock. And this is so we can make sound, informed, and wise investment decisions. So if you've been investing in companies by buying their stock without first looking at the financial statements, it's like you've been playing a game without all the tools available to you. It's like you've been playing basketball with one arm tied behind your back. So that's the what the income statement is, and now for the why. Like, why should you even bother with the income statement? Why is it important? And there's 2 main reasons why you need to be looking at the income statement and all the financial statements before you buy a company stock. 1, and I can't stress this enough, when you buy a company stock, you become part owner of the company. So it's wise to look at the financials of the company that you're now going to be part owner of. So again, when you buy stock, you are a business owner. We are conducting business. So conduct yourself like a business owner and look at the money. And 2, analyzing income statements will actually increase your chances of picking the winning companies or stocks over the losing companies. When you pick the winning companies, you make money. When you pick the losing companies, you lose money. It's simple. And here's why I have to emphasize an important point. See, when people first come into the stock market, myself included, they say things like 5G is the way of the future, or electric vehicles, or gene splicing. And that's where the research ends. We as beginners pick a random company within one of these industries and buy a stock. And usually you pick the one that you can afford. We say something like, Tesla is over $800 and it's an EV company. And this EV company over here is actually only $20. So I'm going to go ahead and buy this $20 one because it's going to go up to $800 like Tesla did. Like, how can I go wrong with electric vehicles? But think about the question. How can you go wrong with electric vehicles or 5G or renewable energy, gene splicing, etc.? These are industries. And while you're probably right to pick these industries and say that they will win in the future, you can go wrong by picking a random company in one of these industries and saying that that company will win. Because each of these industries has hundreds, maybe thousands of companies within them. And trust me, most of them will fail. So the question shouldn't be, how can I go wrong with electric vehicles? It should be, how can I go wrong with this particular company within the electric vehicle industry? And the way you can improve your chances of being right, picking the winning company, and actually making money is by examining the financial performance of the company via the financial statements. Now, next we're going to look at some actual income statements, but first I want to show you a snippet of a video to really drive home this point of it not being wise to just pick a random company within the industry just because you expect that industry to be successful in the future. The snippet is of Warren Buffett speaking on this topic. He's one of the most successful investors of all time. So if you want to make money in the stock market, you might want to listen. The snippet lasts around 3 minutes. So if you want to skip it so you can just go straight to the income statements, then by all means. But you might not want to skip it. You might want to watch it because there's so much value in what he says.
there can be all kinds of companies that have wonderful futures, but I don't know which ones they are. I've given talks in the past where I carry with me a 70-page, tightly printed list, and it shows 2,000 auto companies. Now, if at the start of the 20th century, you had seen what the auto was going to do to this country, the impact it would have on the lives of then your children and grandchildren and so on. It transformed the American landscape. But of those 2,000 companies, 3 basically survive. And they haven't done that well many times. So how do you pick 3 winners out of 2,000? I mean, it's not so easy to do. It's easy when you look back, but it's not so easy looking forward. So you could have been dead right on the fact that the auto industry, in fact, you probably couldn't have predicted how big an impact it would have. But you wouldn't have, if you'd bought companies across the board, you wouldn't have made any money, because the economic characteristics of that business were not easy to define. I've always said the easier thing to do is figure out who loses. And what you really should have done in 1905 or so, when you saw what was going to happen with the auto, is you should have gone short horses. There were 20 million horses in 1900, and there's about 4 million horses now. So it's easy to figure out the losers. The loser is the horse. But the winner was the auto overall. But 2,000 companies just about failed. A few merged out and so on. There were 3 companies, auto companies, in the Dow Industrials in the 1920s and 30s. Studebaker, Nash Kelvinator, and Hudson Motor. Now, those names are all familiar to me, and maybe some of them are familiar to you, but they're not making any cars. They didn't make money, and yet at one time, they were in the Dow 30. They were the aristocrats of American business, and they got creamed. So figuring out the economic characteristics of the winners in a wonderful business is not easy. In North Carolina, Orville and Wilbur took off, or I guess Orville took off and Wilbur watched. I'd have been Wilbur. But if you could have seen the future of the airline business from that point forward and how that would transform things, it would have blown you away. And it's excited people, incidentally, ever since. But if there had been a capitalist at Kitty Hawk, he should have shot Orville down. I mean, because it's done nothing but cost investors money. There were over 400 airplane companies in the 1920s and 30s alone. There was in Omaha. There was in Nebraska. We were the Silicon Valley, apparently, of aircraft. And they all disappeared. It's been a terrible business. At the end of 1991, if you'd added up the aggregate earnings from all airline companies with billions poured in, since Wilbur and Orville were down there, they came to less than 0. The number of passengers went up every year. The importance of the industry was dramatically increased decade by decade, and nobody made any money.
So again, just because a certain industry will go on and do well in the future doesn't mean that you can just pick any old random company within that industry and that company will do well also. And that's the why. We already did the what. So now we can go ahead and get into the income statements. You know what time it is. So the 3 companies whose income statements we'll look at are Apple, Morgan Stanley, and QuantumScape. I picked these 3 different companies because they are 3 completely different businesses. Apple is on the retail side, Morgan Stanley is in the financial services area, and QuantumScape is a SPAC. And because there are 3 different types of businesses, their income statements will look slightly different. I didn't want to just pick one and have you think that all income statements will look exactly alike. So I added some variety. Now let's dive into Apple. Okay, now these columns are the first thing that I want to explain to you on Apple's income statement. Each of these columns represents Apple's financial performance during that 1 year. For instance, this year ended September 28th, 2019. So when you're looking at this column, this year starts from September 29th, 2019 and goes until September 26th, 2020. And this is their performance during that year. Now I want to focus on Apple's sales or revenue. Remember when I told you that the revenue would be the first thing listed on the income statement? So now you can see how Apple generates its revenue and where the money comes from that makes up their sales. They sell products, and they amounted to 220.7 billion because these numbers are in millions. And then from services, they earned 53.7 billion. And their total revenue, or their total net sales, amounted to 274.5 billion for the year ended September 26, 2020. And then next we see the first expenses for Apple listed out, which are the cost of sales. So let me go ahead and explain what cost of sales is referring to. Now, one of the products that Apple sells is the iPhone. And with each iPhone that Apple sells, it earns revenue. But Apple doesn't make these iPhones for free. They don't just, show up all packaged together like this. This iPhone is actually a whole bunch of different parts put together. So someone has to make the parts, and then someone has to put the parts together. And this whole process of making the parts and putting the parts together costs Apple money. And that dollar amount, or the money that it takes to make the product, is the cost of sales, or the cost of goods sold. And this is why Apple tries to make these iPhones as cheaply as they can by hiring the cheapest labor and getting their parts as cheaply as possible. Now, Apple should be able to pinpoint the dollar amount of how much it costs them to make each iPhone. And from there, they'll know how much they have to sell each iPhone for and how much they'll profit from each iPhone. So say Apple sells iPhones for $1,100 each. And then let's say it costs Apple $750 to make each iPhone. And then let's just say that they sold 100 iPhones total. Their revenue would be $1,100 times the 100 iPhones, amounting to $110,000. And their cost of sales will be $750 times 100 iPhones, amounting to $75,000. So that's the cost of sales. Now back to the income statement. And now let me explain this gross margin, or gross profit margin. So when you take the total net sales and you subtract out the total cost of sales, then you'll arrive at this gross margin figure. And gross profit margin just shows you a company's profit before they take out operating expenses, taxes, so on and so forth. And then we have Apple's next expenses listed, which are the operating expenses, and they are made up of R&D, or research and development, and SG&A, or selling, general, and administrative. Now my guess is you wouldn't like it very much if the iPhone still looked like this. If this was the case, then Apple would have been snuffed out by its competitors a long time ago. So Apple needed to innovate in order to stay competitive. So this is why the iPhone now looks like this and no longer like this. Let's do it side by side. Now, it takes money to research and develop and innovate and get from here over to the newer one. And these are your research and development costs. Now, as far as SG&A, or selling, general, and administrative, have you ever seen the Apple geniuses in the store? Yeah, they have to get paid, and so do Apple's many other employees. Not to be mistaken for the labor that Apple hires in order to make their iPhones. Have you ever seen an Apple commercial? Yeah, it costs money. We're not going to get into all the SG&A examples in this video, but you can think about it like this. Cost of sales is the direct cost of making the iPhone, while SG&A expenses are the indirect cost of selling the iPhones. The Apple geniuses don't directly make the iPhones, but they play a vital role in the success of Apple and selling the iPhones. Income statement. So when you add up Apple's research and development expenses and SG&A expenses, you arrive at the total operating expenses. And now we see another figure, the operating income. And to arrive at this figure, you take the gross margin from before, and then you subtract out the operating expenses. And then for other income or expenses, and in this case for Apple it's income because it's not surrounded by parentheses, this is the income that's not accounted for in Apple's revenue or operating income. So in order to catch it, because it does count, they go ahead and add it to this line item here, this other income. And then when you take this operating income and then you add in the other income, that's how you arrive at the income before provision for income taxes. And then taxes are taxes, like you have to pay taxes. So you see provision for income taxes. So when you take the income before taxes and you subtract out the taxes, that's how you arrive at this net income amount of 57.4 billion. So remember when I told you about the other useful information that's on the income statement, such as the earnings per share and the total number of shares within the business? Now this is how you arrive at the earnings per share. You take this net income figure, and then in our case, you divide this net income figure by the total number of diluted shares. So 17.5 billion shares, because this is in thousands. And then you arrive at the diluted earnings per share. And it's good to understand all these line items, but for a quick scan, the figures that I mainly pay attention to are the total net sales or revenue, and then the net income, the earnings per share, and then the total number of shares outstanding. And now that we've seen all of the numbers, we can do a quick analysis to start to put together the story for Apple's financial posture. So you see that total net sales for the year ended 2018 were 265.5 billion. And then in 2020, they had grown to 274.5 billion. Now, that's not explosive growth. What you can do right now is you can actually pause the video and you can calculate this thing out for yourself. Or maybe I'll go ahead and leave it calculated for you. And then you'll see the percentage of how much Apple has grown over these 3 years. But you do see that sales are increasing, which is a good sign. It wouldn't be a great sign if sales were actually going the other way. So going down instead of up. And then when you come down to the net income, you can see that the net income for the year ended September 29, 2018 was 59.5 billion. But now for the year ended September 26, 2020, this number had actually dropped some. So this just tells you that the sales have gone up, but the net income has gone down. So that means that their expenses have increased faster in relation to their sales over this 3-year period. And that's not a good sign. But then over the same time period, even though the net income has gone down, the earnings per share has gone up. And this is because these figures down here would show you that in the year ended 2018, Apple had 20 billion shares outstanding. But now they've actually purchased back shares of their company. So now they only have 17.5 billion shares outstanding. And this is why when a company goes out and purchases their outstanding shares, it's actually a good thing for the current owners of the company and the current stockholders because it increases these figures and adds value. And then to end it off, we'll calculate Apple's profit margin for the year ended September 26, 2020. And how you do that is you take the net income and you divide it by the total net sales. And then you multiply that by 100 to get the percentage. And then when you look at Apple's profit margin, it's around 21%, which is pretty good. I've seen companies with razor thin profit margins like 3% or 1%. So 20% is pretty good. So that's it for Apple. Hey, let me remind you, if you're getting value out of this video so far, go ahead and click the like button and subscribe. On to our next company, Morgan Stanley. And now in looking at Morgan Stanley's income statement, you can see the many ways that Morgan Stanley earns revenue. There are 1, 2, 3, 4, 5, 6, 7 different ways listed here that Morgan Stanley earns his revenue. So in the first section, the total non-interest revenues, you can see that these all amount to $36.7 billion. But Morgan Stanley also earns revenue from interest income. So when you take the interest income and you subtract out the interest expense, you get the net interest, which is $4.6 billion. And then when you add the net interest plus the total non-interest revenues, that's how you get the net revenue. And then next we have Morgan Stanley's total non-interest expenses, which amount to $30.1 billion. And that's all of these added together. And then when you take your total non-interest expenses of $30.1 billion and you subtract it from your total net revenues of $41.4 billion, that's how you arrive at this income from continuing operations before income taxes of $11.3 billion. And then again, got to pay taxes. So taxes of $2 billion. And then the income from continuing operations is the income from continuing operations before income taxes minus the income taxes. And then you see this net income figure of $9.2 billion. But this earnings applicable to Morgan Stanley common shareholders is the one that we're really concerning ourselves with. So to get from the net income to the earnings applicable to Morgan Stanley common shareholders, you subtract out the net income applicable to non-controlling interest, and then you subtract out preferred stock dividends and other. In another video, when I'm looking at just one company at a time, then I can do a deep dive into looking at these different line items to explain what each of these line items mean. But to cut down on time, I'm just again going to tell you the main figures that you should be paying attention to in a quick analysis. The net revenue, the earnings applicable to Morgan Stanley common shareholders, and then the EPS numbers, or the earnings per diluted common share, of 519, and then the average common shares outstanding, diluted, of 1.6 billion. And then again, we'll look at Morgan Stanley's profit margin. And Morgan Stanley is another company with a pretty high profit margin, greater than 20%. And just to be safe, I'll take this earnings applicable to Morgan Stanley common shareholders of 8.5 billion and divide that by the total net revenue of 41.4 billion. And now that we know all the numbers on Morgan Stanley's income statement, we can interpret the figures. So for instance, for net revenues, we see that Net revenue in 2017 was 37.9 billion, and then in 2019 this increased to 41.9 billion. And then again you see that revenue is trending upward instead of downward, which is a good sign. And then you come down and look at the earnings applicable to Morgan Stanley common shareholders, and you see that for 2017 this figure was 5.5 billion, and then in 2019 this figure grew to 8.5 billion. Again, another good sign for Morgan Stanley shareholders. And then you see that the earnings per diluted common share went from $3.07 in 2017 to $5.19 in 2019. And then for the average common shares outstanding, you see that this figure went from 1.8 billion in 2017 down to 1.6 billion in 2019. Again, signifying that Morgan Stanley has been buying back shares of the company. And that's it for Morgan Stanley's income statement. Are you starting to see the advantage that you'll have in picking stocks and investing in companies just by looking at the financial statements? It helps, right? It gives you that confidence like, you know what? I'm investing in a great business. So I couldn't care less what the stock price does in the short term, because in the long term, I feel like this business will be around and growing and be successful for the years to come. And in the future, people will be willing to pay a lot of money for this stock. Or you can look at it and think, nah, I should probably stay away from that one. Either way, this skill will help you to make a lot of money in the stock market and not lose money. Let me show you something else. Now, this is QuantumScape, and QuantumScape is a SPAC, or a special purpose acquisition company. So let me quickly explain what a SPAC is before we dive into QuantumScape's income statement. These are just things to think about. So know your risk if you choose to buy the stock of a SPAC before that SPAC has actually merged with another company that has actual operations. Now, with this in mind, let's look at QuantumScape's income statement. Now, for QuantumScape's income statement, I actually had to go to the 10Q report instead of the 10K report. The 10Q report is the quarterly report, and the 10K report is the annual report. So for the 10Q report, you see that the column is broken down into for the 3 months ended September 30th, 2020, instead of for the year ended. And then this column shows you their inception date of April 17th, 2020 to their last reporting date of September 30th, 2020. Now, there should be one thing that definitely pops out to you, and that is that they have no revenue, no sales, but they still have expenses. You see general and administrative expenses, franchise tax expense, etc. So immediately, because they don't have revenue, but they do have expenses, you see a net loss instead of a net income of 1.46 million. And then when you divide this net loss of 1.4 million by the average shares of common stock of 7 million, you get this basic and diluted net loss per share of 20 cents. Now, as promised, before we end the video off, let me show you how you can find the company's income statement and other financial statements. And that's all for the breakdown of the income statement. plus some other nuggets. I mean, I just couldn't help myself. But I hope you got great value out of this video. In the next video, we're going to dive into and break down the cash flow statement so we can see the flow of cold, hard cash within a business. Now remember, application is how you're going to truly learn these concepts. So go out and look at some income statements. I'll see you in the next video. You know, this business is really just not in my lane. I'm not seeing how I'll be able to come in and actually add value. So for those reasons, I'm out. Practice.